Is the market headed to where the experts thought it would at the beginning of the year? Stay tuned. Welcome to this week's edition of NoteSchool TV, where every week at 11:05 Central Time, we bring you the most amazing content and the most amazing guests, well, every week. This week is it's our monthly update today, and Eddie and I will be going through that. And, we'll see what the end of the first quarter looks like and what's going on in the marketplace. So before we get into that, let's talk about, make sure and like this episode, right? Just hit the like button. Make sure to share it with your friends, your colleagues, folks that you know in the industry. Please do that for us as well. Make sure and subscribe to the NoteSchool TV channel if you have not already done so. And then number 3, make sure and hit that bell notification so that you will be advised when, a few minutes before we go live, every Wednesday at 11:05 Central Time. Also, continue to send in your comments, your questions, anything that you have that's on your mind. Go ahead and send that in to us. Eddie and I love to read those, and we will certainly respond to you as well on those. So with that, I want to go ahead and bring on the founder of NoteSchool, Chief Visionary Officer, my friend, all-around good guy, Mr. Eddie Speed.
Good morning, Joe. How are you?
I'm good. Looks like spring has sprung, and we've got the monthly update. So
we do. It's month end, and we got a lot of information to cover today. It'll be interesting to see if the market is tracking the way the experts thought it would around January 1st of this year. So
let's jump in.
Joe, let me be the first to say Happy Easter.
Happy Easter. Absolutely. We've got Good Friday and then Easter on Sunday. So it's an amazing time. So let's jump right in. So let's talk about the housing market. So February home sales spike 9.5%, right? The largest monthly gain in over a year. And Eddie, that's good news for those in the real estate business, right? And especially realtors.
Right. We at NoteSchool has a lot of realtors in it. We're glad to see them have inventory. I think the market is adjusting to rates now. Joe, you and I've talked about this a lot. This is just the normal rate cycle. 2% isn't normal. 12% isn't normal. 7.5% is normal. It's the average. 7.7% is the average interest rate over 50 years. So as we look at this, we're seeing that hopefully that the consumer market on both sides, sellers and buyers of properties, are now seeing this as normal. And so we're glad for our friends in the traditional real estate business, the brokerage world, and also people trying to move houses in that world. So congratulations, guys. I think the market may be normalizing.
I think it is, as we look and people are just, the change happens and everybody fights the change, and then finally comes acceptance. And there you go. And Eddie, I certainly don't want to have to go back through what we did in 2020 and 2021 and basically 2022 to get the rates back down to 3% again, right?
Oh my gosh. I remember some of those shows that we were doing and oh my goodness, just people going crazy and buying property you couldn't, they were just lost their minds almost. And so we were thinking if you got a little bit of gray hair, you might tap the brakes a little bit on that, That's right. Anyway, glad to see it. And so let's talk about, affordability, because really that's, that's a major thing. I think it's interesting, Joe, in this article, though, it talks about houses literally would have to drop 40% in value 40%. To be what was the affordability number.
Right.
So that's not going to happen.
Right. That's not going to happen.
And, but Go
Rates
ahead,
would have to
Joe.
drop to 2.45, right?
Yeah.
Versus what they are, today as of last year. And look at the incomes, Eddie.
129,000 versus 77.
Yeah, so
So
that's pretty big.
yeah, it's
So,
it is I believe, Joe, in this case, this is the new normal.
it is. It is. And again, it's just that acceptance, and you've got to embrace it, because that's what it is, and I think that's what we're starting to feel, as you said before, is we're just kind of we're getting back into that. People have gotten over the shock, and now it's like, okay, I'm going to buy a house, and we're still good with that. So and I'm glad to see it normalize. I mean, there's nothing wrong with that. All right, so. According to Wolf Rickert on Wolf Street, well, you look at this, Ed. So, Eddie, amid weak demand for existing home, active listing and price reductions jump, listing prices weaken. So, we look at this a little bit from, the 2023, February of 2023 to February 24, which obviously the March data hasn't came in yet. But yeah, talk about that a second.
Well, I think the reality is that when you list a property, we're back to people countering, or people having to pay, a part of the closing cost. And the reality is that's just where we're going to be. And, so it's not the over list, overbid, 14 people standing in the front yard with a contract that we had at one period in the cycle. So we definitely are back to, back to that. And, and so, I think it's just, like I said, I think this is, we all have kind of known this would happen.
Yeah.
And, this is just, the market just adjusts to, as they say, water seeks its own level.
It's the equilibrium, right? It is. All right. Remember the saying we were using back in during COVID, right? It'll fit any container that water liquid will fill the void in there of whatever vessel you put it in, right?
That's right.
That's it. Right. All right. Well, let's talk about shift in home prices. So this is Freddie Mac traces the home price index, and this is among the 384 metro areas that Freddie Mac tracks. So Brunswick, Georgia, right?
All right, so let's talk about this. This is their top 10 of 384 markets.
Yep.
This is their top 10. This is the best.
Right.
Right. And so there's some markets that, are not exactly what people thought. I used to buy a lot of mortgage notes down in Brownsville and Harlingen. That's called the Valley in far South Texas down there.
That's right.
Anyway, they're not exactly what people would have been thinking. Those markets there are not exactly what people would have picked.
Well, Eddie, you would have never picked that. Now, as we look at the lowest of the 384 markets, these are markets that we would all know, right?
Yeah.
Yeah.
So there are trending up. These are the bottom 10. This is the bottom end of that list. And there's some familiar names in there that were hot as a pistol back when they had the FOMO going on, fear of missing out. Austin, Texas, Idaho Falls, Boise, Idaho, Coeur d'Alene. Those are all now markets that are on the downside. They're going down.
Right. And
so, Joe, explain what the red column really means.
So the red column, well, simply, so we've got, and this is from before, so we've got the month over month is the first, then we've got year over year. Then I got to go back one slide here. Then we've got since the peak in 2022, it's gone down 14.5%. And then since 2020, since the beginning of 2020,
it did increase, but it slid back from where it was.
It did. And it was way over. I mean, it went through the roof, right?
Yeah.
And, oddly enough, the number one area right now where the most millionaires are moving is none other than Austin, Texas. I was doing some research last night for this, and that's it's where a lot of people are moving. Tech is really going into there as well.
No doubt. It just got overheated. I had a friend that had some investment property in Austin, and I was very good friends with him, and I said, "You really need to sell." This was in 22. I said, "You really need to sell. Like, it's time. You need to move it." And the other day I saw him, and he says, "Do you realize the timing that you told me to sell? I could look at a graph, and you hit it at the very peak of the market." And I laughed and I said, "Lucky guess," but I knew it was going to change. And I didn't know.
Eddie,
nobody can say exactly when. So that was a lucky shot. But yeah, so anyway, pretty interesting. We're not.
Well, Eddie, let me say this too. If you'll remember, it was we reported on here a couple of years ago that Sacramento had been kind of, you had San Francisco, and then below, you had Sacramento. And so they reported that Sacramento was the most affordable place to live in California, right? So it seems that the people left San Francisco, went to Sacramento, drove the prices through the roof, and now it's kind of settled back down, right? And that's what we see with a lot of these markets.
Yeah, they just got overheated. I don't know what happened to Hammond, Louisiana there, but that's between New Orleans and Baton Rouge, and I'm not sure exactly why Hammond ended up on that list, but it did. So there you go.
All right. So, Eddie, big news. We all heard it. It started over the weekend. As reported by The Hill, Realtor settlement could bring seismic shift to the housing market. So let's talk about that for a second.
Well, I'm sure that there are some people that might be a little surprised that we've not mentioned this. We have fully known about this. We train some of the top residential realtors in the United States in NoteSchool, so it has been clearly a topic that has been kind of a private conversation.
Mm-hmm.
Honestly, they just don't know what's going to happen yet. Right. And people, there's all kind of people out there, and they got a big hot sports opinion and stuff. Yeah. The most sophisticated realtors we know really just don't know.
Yeah.
Like, that's really the truth. As this thing unfolds, we're going to bring more to this story, but we just have decided not to bail off down the hill and say something because it's a newsworthy item when nobody really knows how it's going to shake out yet. And so I'm going to say to you, Joe, we're going to keep our powder dry on this.
Yeah.
We are watching it. We're very familiar with it. We deal with a lot of realtors. We have a lot of connectivity. We will bring this as probably even its own show, but not yet.
Absolutely. As the story unfolds, as they say.
Yeah.
Well, Eddie, let's talk about banks. What's going on there? So this was you and I both kind of spotted this at the same time, and we were texting back and forth. So Fannie Mae, revises the mortgage rate predictions as we go through 2024. And, their economists, the big economists, they're going to be a little higher this year than previously thought.
Yeah, what's interesting is the economists are calling for not the recession they thought we were going to have, but they're also calling for the fact that rates aren't really going to drop the way they predicted they would drop. So here's the answer to the question, Joe. This is kind of what is making us say all that we're saying, which is, the market is stabilizing. People have mentally gotten accustomed to the rates. I'm not saying it doesn't affect affordability. We're not saying any of that stuff isn't the case. But, Joe, there's a low enough supply that there's still people buying, and there's still a demand. I think generally speaking, we are the experts are sort of calling for a flat market this year as far as residential, not on the commercial side necessarily, but on the residential side, kind of a flat market. There are some rumblings out there that some of the rating agencies and stuff like that are not calling for a flat market. They're calling for a little bit of a decline. And so we're watching that. Yeah. I know that's a truth. I absolutely know that's a truth because I'm fairly connected with people in the mortgage banking world, and I know that rumbling exists.
Right.
And we're not chasing the headlines over it. We're just kind of saying, I think we're sticking with the story. But yeah, rates are not gonna drop as much as originally predicted.
And, we look at what they are now, and Eddie, this isn't, the 7.29, and we call that, that's the annual percentage rate. But right now, the best rates are around 7.12 on the advertised rates. I was just looking at a few minutes ago. So here they are, right?
All right. So understand, once again, we print and produce to you guys the APR, which is the effective rate, not the rate on the note.
Mm-hmm.
That rate on the note can be like as much as 1% less.
Right.
But that's not the real rate. The effective rate is what people are really paying. And so, Joe, I see you changed it to Michigan this time.
I forgot to change it to Texas. I just saw that.
I don't care. Michigan's fine. I'm all good with that.
We got a lot of folks in Michigan, right?
Too. Yeah. All right.
All right. So let's move on. So, Eddie, this is first lien mortgage originations, right? As unpaid principal balance. And this is as reported by ICE, which is formerly Black Knight. And so let's talk about this a minute.
All right, so Joe, I want you to do this. I want you to go over there and in the 2 trillion column, highlight that.
Right. So I'm going to go all. Right.
And then
I want how straight that line is, dude.
Great shot there, Joe. And then I want you to go to the 4.5 trillion, and I want you to take that over to where we were back in 2021 and 22.
So let me go ahead and make an up one here. So I'm going to go right through here, and then I'm going to go right across here.
Yeah. So, ladies and gentlemen, mortgage production is down more than double of what it was.
Yeah.
It was double of what it is today. And people want to know what's the issue. And the issue is pretty simple. That blue represents refis, and there ain't no refi business.
No.
And so that's the deal. And I don't believe there's a fix in sight. And we're going to continue to see. This is causing, Joe, this is one of the reasons that mortgage banks are selling discounted, reperforming, and non-performing notes. This is one of the reasons for it. And so if you want to see the effect of it, it has nothing to do with anything other than the fact they're trying to clean their balance sheet up because, as we saw the last 6 months of last year, they lost about $1,000 every time they originated a loan.
That's right. So, absolutely. Yeah. And when we look at that again, I mean, with what the figures show, about 80% of the loans out there that are out there right now are less than 5%.
Yeah.
So that's the origination or the refinance really is hit hard for sure.
That's correct.
Let's look at the top banks, the top U.S. banks by share of commercial loans. These aren't the biggest banks, right? They're not the J.P. Morgan Chase or the Bank of America. These are the banks that are sitting with, a pretty large share of their assets. This is Bank of the Ozarks, and $17.4 billion in there of their
almost 70% of all the assets in the bank.
Right.
Right. And you see that even the bottom end of that's about 50%. So we saw the other day a chart from on NoteSchool TV where we had about 44% of the banks, other than the top 25 banks, 44% was the average of percentage of their total book of business in commercial loans.
Right.
So, Joe, we know that there's a lot of talk about this. It's going to unfold. The bomb is 2 things. It's the rate reset. So assets that are due for a balloon, and the rate is going to be reset at a far different rate than it originally was written at.
Right.
And the second thing is the decline in real estate values, and lenders coming to the borrower saying, when you refi, by the way, we're not going to refi the same amount of money. We're making you drop down. And so you're seeing this very common in all commercial classes, that they are saying we're requiring a principal reduction. And so there's a lot of controversy in that, particularly in the multifamily space, because they're doing capital calls to shareholders of syndications.
Well, that's it. And when you look at, like you said, you're marking the refi rate at the market. Yeah, that's a big deal.
So we'll monitor this, but these are the reasons there's a concern in the market, and
Right.
banks clearly got kind of overloaded here. And, they kind of put themselves in a box a little bit, and I think they're going to have to live with the results.
Well, and the smaller banks, obviously, they went for that business because that's the business that was kind of left over for them. And so, yeah, so let's talk about commercial multifamily.
All right.
So here we go.
The big thing here is the rent growth, or in this case, the negative rent growth.
Right.
And so the issue is, and these are asset classes: A class, B class, C class apartments. And really, Joe, the trend lines are what you see. Mm-hmm. It's what we've been discussing. It's what people are feeling in the market.
Right.
Rents are going down. Expenses are still going up.
Right. Rents
are coming down. And so the margin of cash flow keeps shrinking out of these properties.
Right.
So it's kind of, at this point, Joe, somebody could say, well, this sounds like a broken record. And the answer is, it kind of is, but it also is causing the market to be what it is. And people say, why do I care? And the reason I care is that this is driving a lot of capital into the note buying business that would have been in the multifamily business.
That's right.
That's why it's what's causing it.
And, Eddie, so with the, in the headline there too, is the concessions likely, continue to head up. And what's happening is the newer units, the A units, as they come online, they're having to give concessions for a while until they can get those apartments filled. And then you'll see the C's and so on. That's where the most effect is really going to be in those B- and C to C- properties, right?
Mark my words.
Yeah.
They will rent up all these brand new units.
Yeah.
They will rent them up with free rent. They'll rent them up with free cable. They'll rent them up with free parking. They'll rent them up. And what they will do is they'll draw off of the older units.
That's it.
And it's happened every cycle I've ever seen. And I'm not a multifamily guru, but I've been around this space quite a bit in my career, now 4.5 decades long. And I predict that we will see the multifamilies get rented up, the brand new ones.
Yeah. And
we'll see it. They'll draft off of the older guys, and we will see a continual decline in rent in those older properties because of that. That's going to be the orange line.
That's it.
All right.
And that is why the windshield's bigger than the rear view mirror, right?
Yes, it is.
Yes, it is. Adam Data Solutions. I think our friend Darren Bloomquist used to be with Adam for a while. Now he's with foreclosure.com, obviously.
So we're seeing an increase in foreclosures on commercial property, and this is a little bit of Captain Obvious, based on what we've been saying. And our friends here in Texas make the list.
Yes, they do. Yep,
along with New York and California. So
New York, California, and Texas.
So, yeah, these are the 3 biggest states that we're seeing it, and we're watching it. And people say, when are you guys are going to dive into the non-performing loans on commercial? And I'm saying we're watching we're paying attention to the trends. Yes. We think the knife has yet to fall as far as it's going to fall, meaning values haven't hit the bottom yet. And so we're going to kind of look into it. That we're buying some commercial related notes now. Yeah. It's not like we don't buy any. And we see some really make sense deals. So not every deal doesn't make sense. We're just watching it. We're just seeing what's happening. Okay.
So Saturday you sent me a text saying, "Hey, have you seen this by our friend Dr. Phelps?" And so I read the great article, by the way, Eddie.
Yeah, Dr. David Phelps is a dentist, but I will assure you, we know Dr. Phelps really, really well. He is a long industry friend and a personal friend of ours. Smart guy, very responsible, and very savvy in the market. So He does write for Newsmax, and on Newsmax Money, he wrote about really people investing and getting hustled in the investments that they've made, and a great article there. And he's experienced that and he's seen it, but he's a real street smart, savvy guy that we all love and respect. I've been on his podcast many times talking about these same topics. So he interviews a lot of people like me. And I guarantee if you read that article,
him on the show at least once a year for the last 3 years. 4 years.
Yeah. And so we're watching it closely, and I know he is watching it, and he wrote a great article. If you're interested in it, there's the information on it. It really just is saying that a lot of people that have invested, particularly in multifamily, have been hustled. Right. They
the syndications and
Joe, there's a saying: there are promoters and there are operators.
Yeah.
What you don't want to do is find out you're investing with a promoter.
Yeah.
I'd rather be dealing with the guy that's a little more boring and the operator.
He's got a little skin in the game, right? He can lose if I lose.
He just is not willing to overstate things as quickly as the promoters are. So anyway, congratulations on that, Dr. Phelps.
Yep, absolutely. So here we are, Eddie.
Well, I mean, here's the thing, guys. The trees are growing to the sky, and that's what the promoters sold. And now all of a sudden that has turned out not to be a truth. And we said this before, we have a lot of capital coming and repositioning in our business. We're seeing it very often. We're certainly seeing it in people that join NoteSchool. We're certainly seeing it in our NoteSchool students that we're helping do the business and where they're raising money. So it would be fair to say that the biggest competitor that raising money for notes has had in the last few years has been multifamily.
Absolutely.
Are we like pouncing on them? No, we're just simply saying it's timing and it's a market condition. Notes are hot right now and apartments aren't so much. And it's
just a cycle.
Hey, Joe, you know what? I've ridden all positions going down the road on the bus. You get what I'm saying?
Right.
I've driven the bus. I've ridden in the back. I've ridden underneath. And I've ridden on top. Okay. And so things are pretty good for our industry right now. And we're you're seeing that. You hear us talk about that. And so, it is just what it is. We are creating an awareness so you can make good decisions.
Right. It's like the old kids song, right? The wheels on the bus go round and round. And that's what they continue to do, right?
That's the truth.
All right. We're going to wrap up here with non-performing loans. So here's kind of an overview of mortgage performance. Eddie, talk about this for just a minute. And this is from our friends at Black Knight Ice.
Well, we could have gotten way down the road with current delinquency or current, trends in delinquency. The reason there is a lot of residential non-performing mortgages is because there's been a pin-up inventory.
Right.
And that pin-up inventory is been extremely predictable that as time elapses, that those assets are going to get moved in the foreclosure status and they're going to get sold into the secondary market. That is exactly what is happening. That we knew it was going to happen. It always takes longer than you think, but 2024 obviously seems to be the year for it. I can tell you right now, Joe, that the assets that we have available to us is drastically different than it was. And I can just say that we're living what these charts are explaining. That's right. Foreclosure starts are up 43%. And those generally are because that means right behind that, then the lender starts selling the assets.
That's it. The lenders aren't in the home business. They're not in the real estate business.
Well, they don't have the people horsepower to go handle all those non-performing notes. They don't want the headline risk. They don't want to. They're not looking to be in the news, so to speak. And then secondly, they just don't physically have the people horsepower to do it. And so that's why these loans get sold in the secondary market.
And as we used to say, Bank of America didn't want to be known as the bank that had to foreclose on America. So, yeah, for sure. Right. Bad optics, Eddie.
Yeah.
So let's talk about, loan counts. They're just, they're the average days there. It just goes along with the story. It goes along with what really is happening out there.
Well, the two categories you'd pay most attention to, Joe, go to 90 plus and loans in foreclosure. And basically, if you add those up, then you're looking at almost 700,000 loans.
That's right.
And so these are the loans that are an issue that will become assets that we buy. We're not going to buy 30-day delinquent loans or 60-day delinquent notes. But when you get it says 90, that plus sign means something. Okay. Yeah. And we're saying plus is in how delinquent are they? Well, it says that loans are 90 plus are an average of 1,014 days delinquent.
Yeah.
So you got 700,000 loans that are more than 3 years since they've made a payment.
Right.
This is what we keep referring to as the pinup inventory. This is what we keep referring to. By the way, these reports are always 30 days behind. So Joe and I are not behind. We're actually on the money on this.
Yeah.
And we're monitoring it. We're seeing it. And as the market trends to this area, the good thing, Joe, is that we're buying non-performing notes in a market that doesn't have a steep decline in real estate and residential real estate values.
Equitable market.
So it's very unusual that we've been able to play in this space and buy non-performing notes in a market that is not going down, but that is where we're at.
It is.
And Joe, that's a lot easier to buy loans than ones that you're in a market where the market is declining. So
yeah, and the taxes are usually current, and the insurance is usually on the property. So yeah, that's certainly a good thing there for sure.
Yeah. All right.
All right.
Well, thank you guys. I hope this market update has been valuable to you. We are seeing a significant insurgence of people that are interested in notes. So if you're kind of new to NoteSchool TV, you've kind of gotten owned to this, then yeah, we are seeing a significant surge in people becoming interested in this asset class because you're buying real notes that will produce real income and a predictable income, far better cash flow for dollars invested than any of the other competing markets, which are rental properties, multifamily, other syndications. Our asset class is producing cash flow, and it's also producing opportunity on the non-performing side. So if that's of interest to you, Joe is going to tell you how to find out more.
That's it. Well, guys, so yeah, we'd love to hear from you. Simply go to noteschool.com/TV, noteschool.com/TV. We would love to have you in one of our master classes. So just go there and inquire about what you need to do to get registered for one of those. And we look forward to seeing you there. And none other than Mr. Speed and, Mr. Max Keller does those master classes. So we look forward to seeing you there and hopefully at a 3-day class sometime soon. So have a great Easter, blessed Easter, and we'll see you next week. Same place, same time.